Let's dive deeper into the economy and the market reaction with Sadiq Adatia as Chief Investment Officer at BMO Global Asset Management. Good morning. Nice to see you.
Thank you.
Okay.
Thanks for having me.
When you see a headline like this one on inflation, what does it tell you?
It's actually not too much to give additional information to the Bank of Canada. I think, they're happy it's coming down, and the headline is good from that perspective. But I don't think it really sways the decision too much one way or the other. My hoping is at least it will give them an opportunity to say, let's wait a little longer before we decide to do something else. And that something else still probably is hinting towards upside, like the Federal Reserve is as well. But I think generally, if they look at the underlying economy, they should be seeing there are some weaknesses there that tell them that probably should stop right now and stay on pause for a bit of time.
So I get the risk of raising rates further is that if signs of inflation are already cooling and show more signs of cooling at a time when there's worries about where the economy goes from here, there's the risk that they go too far. And I guess the flip side of that is if the inflation is not cooling fast enough and the economy is holding up well enough, there's a risk of not getting inflation back to those levels that they're so hopeful we can get back to at some point?
I think that's exactly the decision they are faced with. The key to me is still that the economy is weakening. I think everybody can agree to that comment. And there's no rush to raise rates right now. I think you can wait again and see how the economy continues to progress, because you are seeing a pattern of lower inflation, just not fast enough. And the question is, do you need to have inflation at 2% by end of the year? Or are you okay with getting inflation at 2% at some point next year? And if it's the latter, then they should be waiting and pausing for now. If the goal is trying to get by the end of the year, which I think is unrealistic, then you have to go a little bit more aggressive. But I don't think that's the right answer.
We got actually from the Bank of Canada a business outlook survey yesterday. And I mean, there's all sorts of things you can read into from something like that. But probably no surprise, you got a lot of businesses that are starting to get cautious when it comes to the outlook. But in terms of passing on some of the prices that they're getting for their inputs, it seems like they are still ready to do that. So that sort of inflation monster, I guess it's deeply entrenched at this point. Have you formed an opinion on where you think the economy lands throughout all of this?
Yeah, our base case is still a soft or mild recession, which is about a 50% probability. A soft landing is still just as attractive as well, to a 35% probably. So we don't expect anything too severe or whatnot. I will highlight, though, that I think that the consumer still has not fully had the impact of these higher interest rates quite yet. They've only had a partial impact of all of this. I think over the next couple of years, they will truly feel the impact of that. That will impact the housing market, that will impact job market, and that will obviously impact consumer spending because of the consumer sentiment.
Is that because you keep hearing these stories, I guess if you tie it back to the mortgage market, like we have this shorter duration mortgage market where people will steadily be refinancing, I guess, over the next couple of years, and some of them will get sticker shock, and those might not be the people who are dealing with that today?
That's exactly right? So you're only seeing a portion of the population curb their spending. A few more next year and a few more the year after. Plus, on top of it, the ones that have curbed this year have another 2 more years of that pain coming through in the next couple of years as well. So to me, that's really why I think the Federal Reserve and Bank of Canada, both on both sides of the border, should be very cautious about what they do at this point. There's enough pressure points on the consumer, not just at the moment, but in the future years as well.
So most of the time we try to get a sense on where the economy is going, and obviously there's been a lot of concern around that for a very extended period of time. Maybe based on what you're saying, we should ask the question, where could the economy go over the long term? Are you concerned about the broader growth story for Canada at a time when we have record population and a number of factors that could be playing into our GDP story?
Yeah, I mean, it's a bit more of a balanced story. I like what the energy story is going at the moment. The supply is limited at the time. Demand should continue to still pick up. We're seeing a lot of immigration coming in that should fuel the economy stronger and demand for a lot of things going forward, including housing at some point in time. Yeah. However, the question is, the affordability to own a home won't be there. And will that just mean the rents continue to go up higher going forward as well? So to me, I do think the economy has, a bigger crack in it than the U.S. economy does, which is why we've taken out our position to be underweight Canadian equities now. More risk to that economy, not just now, but again, as we continue to progress over the next few quarters and years.